investors continue to debate whether inflation, stagflation, or a recession and deflation will result from the current economic environment. On one hand, we have more than a decade's worth of ultra-loose monetary policy and then fiscal stimulus on top during lockdowns, with supply chain disruption and tight labour markets. On the other hand, we have an end to and even the withdrawal of monetary and fiscal stimulus, lofty debts, and the demand dampening effects of higher prices. No one knows what's coming next, not even central bankers, and this week may provide some information with headline inflation figures due from China, America, and Germany on Wednesday, the 11th of May. Remember that last time around, consumer price inflation in China was just 1.5%, actually below target of 3%. However, wholesale price inflation, or WPI, in Germany was 22.6%, the highest figure since modern records began in 1962, to suggest that consumer prices could see further increases, even though inflation already stands at a 41-year high in Germany of 7.3%. And consumer price inflation in America, well, that was 8.5% year on year, the fastest rate of gain since 1981, when, please don't forget, the Federal Reserve's headline interest rate was 12.38%, an awful lot higher than it is today. Central bankers, economists, investors, politicians, and shoppers will all look to these numbers hoping for some degree of relief. But it's worth bearing in mind in the 1970s, when inflation and stagflation really took hold, that there were successive waves of price increases. Note that this chart uses the Consumer Price Index, or CPI, for America, and the Retail Price Index, or RPI, for the UK. The latter dataset's got a longer history, even if it's no longer an officially recognised statistic. Now, on the corporate front, around a dozen FTSE 100 firms are scheduled to release results or host their annual general meeting in the week ahead, so investors will have plenty to ponder, especially as a good range of mid and small cap firms are slated to do the same. Names which may be worthy of further research for what they've got to say on current trading and the macro environment include the following, although these dates could yet be subject to change. Victrex on Monday the 9th of May, Renishaw on Tuesday the 10th, ITV, Spirax Sarco, Compass, Airtel Africa and Dignity on the 11th, Coca-Cola Hellenic Bottling Company, 3i, Convatec, Balfour Beatty on the 12th, and then finally Sage on Friday the 13th of May, no less. But the company which could really cause a fuss in the week ahead is BT. The telephony, broadband, mobile and TV services provider will publish its full year results on Thursday the 12th of May. The shares are up a little over the last year, but perhaps not by as much as you would have expected given the whirlwind of stories that have surrounded the firm. They have included bid speculation, thanks in part to private equity firm KKR's bid for Italy's Telecom Italia, BT's equivalent are down there, and thanks in part to the 18% stake acquired in BT by French telecoms magnate Patrick Drahi, though whether the UK government would permit any takeover is an interesting and separate question in itself. Then there are the talks with Discovery to merge BT Sport and Eurosport UK to create a new 50-50 venture. And we also have the arrival of Adam Crozier as chairman, replacing Jan du Plessis, who stepped down after media reports of a clash with chief executive Philip Janssen. Mr. Crozier's spell as chairman or chief executive of ITV, Whitbread and ASOS would suggest there could be plenty of corporate activity to come, even if his time at the helm of Royal Mail, well before its privatisation in 2013, is still tinged with some controversy. Mr. Crozier started work at BT on the 1st of December. No doubt analysts and shareholders will be looking for comments on all of these topics from boss Philip Janssen, but the figures themselves will be important, not least because the results for the first 9 months of the year were frankly pretty mixed. Revenues have generally undershot expectations thanks to COVID-19 and supply chain related issues, but profits and cash flow have generally met them, thanks in the main to cost efficiencies. Last November, BT announced it had reached its £1 billion target for cost cuts some 18 months ahead of schedule. For the full year to the end of March 2022, analysts have penciled in the following for the 3 key headline figures. Sales of £20.9 billion, that's down just over 2% year on year. Analysts will also look for any guidance for the new financial year to March 2023, when the current consensus is for an increase of just less than 1% to total sales of £21 billion. BT's preferred metric is earnings before interest, taxes, depreciation, and amortization, or EBITDA, on an adjusted basis, which is not an officially recognised accounting metric, I should stress. The consensus forecast is £7.6 billion of adjusted EBITDA, a 2% increase on last year, and smack in the middle of management's guidance range. For the coming year, analysts are expecting a 4% advance to £7.9 billion. Again, exactly as management has continued to guide so far. The third headline figure, well, that's the dividend. Analysts looking for a full year dividend of 7.7p per share, in line with the payment targeted by Mr. Jansen after the cancellation of the final payment in fiscal 2020 and the decision to pay nothing for fiscal 2021. Analysts are then looking for broadly no change in the next couple of years. Now, that may be partly due to BT's balance sheet. It ended the last fiscal year with net debt of £12.8 billion, a pension deficit of £5.2 billion, and lease liabilities of £6 billion. As a final point, keep an eye on capital spending, as BT seemingly looks to focus on its 5G mobile and fibre broadband services. Analysts are looking for cash spending of around £4.9 billion to £5 billion for each of the next 3 years, including the current one, up from £4.2 billion last time around. Those numbers exclude non-infrastructure spend and IT, so the headline capex number will probably be higher still. I hope that you and your families are in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.